Welcome to The Explainer. All right, let's just dive right in because today we are embarking on a really fascinating deep dive into two fundamentally opposite approaches to running a public company's finances. If you've ever wondered how the gears of corporate treasuries actually turn, well, you are in the exact right place. We're going to look at the numbers, the philosophies, and the real-world results of two completely different financial playbooks operating in the exact same economic climate.
Now just look at the sheer scale of the contrast we're dealing with here. On the left, we've got Strategic Education. They're a traditional company in the education sector, reporting a very respectable, steady net income of $37.2 million for the second quarter of 2026. Okay, but then on the right side, we have Strategy Inc., an enterprise software firm turned Bitcoin Treasury company, reporting a jaw-dropping quarterly net loss of $8.22 billion. Yeah, that is billion with a B. So how does a company even sustain an $8 billion loss in a single quarter and, keep the lights on? Let's break it all down.
Section 1. The traditional path, looking at strategic education.
Think of this company as our control group. It's the old school way of running corporate finance, basically the exact model you learn in Business 101. What traditional success looks like is steady, predictable growth. Their Q2 2026 revenue came in at $337.3 million, which is a solid 4.9% increase year over year. But more importantly, look at the adjusted operating income sitting at $52.9 million and their free cash flow for the first half of the year hitting $92.4 million. This is a company that provides a service, gets paid for it, pays its expenses, and actually generates free cash from its core operations. It is a completely self-sustaining financial engine.
Looking at the core mechanics of their business, their revenue per student was roughly flat, but they drove overall growth through specific healthcare and employer programs. And because they generate actual operating profits, they can afford to declare and pay a 60-cent per share quarterly cash dividend to reward their shareholders directly. They can even absorb normal, unexpected business bumps, like, say, setting aside a $13.9 million reserve for an Australian Fair Work compliance matter, without derailing their entire financial health. It's stable, it's steady, and honestly, it's highly predictable.
Section 2. The Bitcoin Behemoth, Strategy Inc.
If Strategic Education is a quiet, reliable sedan, Strategy Inc. has essentially strapped a rocket engine to their balance sheet and aimed it straight at the highly volatile world of digital assets. Look at this number right here. 843,775. As of July 2026, that is the exact staggering amount of Bitcoin held by Strategy Inc. They aren't just dabbling in crypto, they are literally the largest institutional holder of Bitcoin globally. They fundamentally transform their entire corporate identity around accumulating this one digital asset.
But there is a massive, almost comical disconnect between their traditional business and their treasury. In Q2 2026, Strategy Inc.'s core enterprise software business generated $122.39 million in revenue, which is a perfectly fine number, right? But the value of their Bitcoin portfolio at that exact same time? Approximately $54.77 billion. Their treasury operation has entirely eclipsed their actual software business. It makes them essentially a Bitcoin holding company with a software division just kind of attached to the side of it.
Section 3. Paper losses, real assets.
So how exactly does holding billions in digital assets translate into an $8.2 billion quarterly loss? Well, the mechanics are right here in the numbers. They hold 843,775 Bitcoin. Their total cost basis, meaning the amount they actually spent to acquire all that Bitcoin over time, is $63.69 billion. That makes their average cost roughly $75,476 per coin. But look at the market value row. In July 2026, the market price per Bitcoin dipped to $64,915. That means their portfolio's market value dropped to $54.77 billion. So they're sitting on a massive, unrealized deficit compared to what they initially paid.
The absolutely crucial point here is how accounting rules treat this situation. Under a standard known as ASU 2023-08, companies are now required to measure their crypto assets at fair market value. So every single time the price of Bitcoin drops during a reporting period, Strategy Inc. is forced to recognize those price fluctuations as a net loss on their income statement. This happens even if they haven't sold a single coin. It's a paper loss for sure, but it's reported as a massive operational hit. This is exactly why their earnings reports are so incredibly volatile.
But here's the thing. They aren't slowing down. Look at this figure. $17.06 billion. That's the amount of capital Strategy Inc. raised year-to-date in 2026 just through at-the-market stock offerings.
They are aggressively tapping into traditional capital markets, issuing shares, and using those billions in cash proceeds to just keep buying more and more Bitcoin, completely regardless of the paper losses.
Section 4. The liquidity pivot.
Now, you can only operate in such extremes for so long before reality forces an evolution, right? Let's dive into their new playbook, which they are calling digital credit. Here's the mechanical loop. First, they issue preferred stock, specifically under the ticker STRC, and they take on debt. Second, they use the vast majority of those proceeds to buy Bitcoin. But here is the massive shift in step 3. They now maintain a staggering $3.75 billion US cash reserve. Why? Well, for step 4, so they can actually act like a traditional company and pay a massive 12% cash dividend to their preferred shareholders.
The great paradox here is captured perfectly by their CEO, Phong Le. He admitted that the biggest lesson of 2026 was the necessity of holding cash reserves. He explicitly stated that preferred shareholders view US dollars differently than Bitcoin. It is a pretty amazing paradox. They are the ultimate Bitcoin treasury company, yet they had to concede that traditional market investors still absolutely demand the safety and liquidity of cold, hard US dollars to cover those dividend and interest payments.
And to fund that massive dollar reserve, they actually had to break their own golden rule. Look at this monetization program. In 2026, they sold 3,620 Bitcoin for about $218.4 million. This marks a radical departure from their original never sell thesis. Actually, scratch that, it's more like a total paradigm shift. They are actively selling portions of their Bitcoin stash to fund that USD reserve, to pay those high-yield preferred dividends, and even opportunistically repurchase 28.9 million of their own preferred stock at a discount. They are transitioning from being passive hoarders to highly active treasury managers.
Executive Chairman Michael Saylor perfectly encapsulates this strategic pivot. His goal isn't just about Bitcoin going up anymore. It's about stabilizing their financial instruments. He noted that their plan is to return their STRC preferred stock to health with stable demand, high liquidity, and low volatility trading near par. Amid a lot of market skepticism, they realized that to keep the whole machine running, they had to offer traditional investors the stability they crave, even if it meant selling a little bit of the digital gold they worship.
Section 5. Redefining corporate treasury.
So, what does this all mean for the broader financial landscape? Well, we're essentially looking at two totally divergent philosophies side by side. On one side, you have the traditional model of strategic education. You build a business, you reinvest your actual operating profits, and you pay modest dividends from a steady stream of free cash flow. It's kind of boring, but it's bulletproof. On the other side, you have the digital model of Strategy Inc. You leverage the capital markets to raise massive debt and equity, you acquire highly volatile digital assets, and then you actively sell those assets to fund massive USD reserves and high-yield dividends just to keep the capital flowing.
So, the crucial question I want to leave you with today is this. Is the future of corporate treasury traditional stability, or is it digital volatility? Can a company sustainably engineer a massive dividend loop backed by literally the most volatile asset class on Earth, or will the slow and steady cash flow model always win the long game? It's a fascinating financial experiment happening right in front of us in real time, and it's definitely one we should all be paying very close attention to. Thanks for joining me for this explainer. Keep asking those big questions, and I'll see you in the next one.